I always like to start off with a summary of kind of what I saw happening with the stock market this week. This particular chart that you're looking at here is actually from the very top, beginning of last year on the S&P 500 to just about an hour ago. And so what we have here, as you can see, obviously, is we had a series of peaks that were declining all the way throughout the year last year, connected by that red line. Finally broke through that trend line this year, went back and challenged it again, this month. And now we're having a really nice run again, and we'll talk about that some also. And we started to discuss what we call our signals. So we have a whole process, kind of an algorithm that takes a look at what's happening with the market and gives us kind of a green, yellow, red light signal. And so currently our stock market signal is two pieces: a fast signal that we use for things that have really no tax consequences, like Roth IRAs or regular IRAs, those types of things. And the slow signal we use for more of the taxable accounts. So the fast signals historically had a better rate of return, but produces more transactions. Since we don't have cost for transactions anymore, that's still kind of viable. The slower signal is more for those things that are going to produce taxes, or at least have to be accounted on the tax return. And that signal historically has done well also. So we'll see how this goes. But that signal for the fast just turned to green yesterday. And you can kind of see why. We've had this big run up here that's really kind of driving things. And so today would have been a day that we would be looking at making some changes from where we were before to, our green holdings would be things that are kind of high momentum, moving along with the markets, designed to kind of maybe outpace the market when it's going up. And the issue that we have right now is that this is the very end of the quarter. And so let me share a chart here with you real quickly. I'm going to change format so you can kind of see. So this is the S&P 500 going back again really to the beginning of 2021, end of 21 to today. And I have done this on weekly data. The previous chart we just looked at was daily data, just so you can see this a little bit easier and we can get it all on the screen. So what I did is I put in the end of each quarter. And so if you look at the end of the fourth quarter there, 2021, that was actually the all-time high that week. That was it. And then we had a nice run up in the first quarter of 2022, and right away it started down. And then the second quarter wasn't quite exactly the bottom, but fairly close before the biggest run up we've had so far was into the summer of last year. And then the third quarter, which is right next to me here, which was, end of September, that was almost the all-time low for this particular downturn. It came a couple weeks later, but turned around, went up. Fourth quarter, another big drop off. A lot of you that have been watching me on a consistent basis might recall that at the end of the fourth quarter, the market was doing really horrible all the way through the Christmas break and everything. And I kept saying, there was this rebalancing happening, and that these big funds are rebalancing. In this particular case, they're selling stocks and buying bonds, and we just need to be patient. And lo and behold, beginning of the year kicks in and it takes off, and we actually had a really big January. So it seems, if you look at it, wherever it is, and it peaks out at the end of the quarter, whether it's down, it starts back up. If it's up, it starts back down. And so what we want to do here, and this is something I've been cautioning people about for quite some time, you got to be careful with making really kind of judgments and analysis at the end of quarters, because it can be kind of distorted. And what's happening is, again, you have these very large pensions, very large target date funds, which are in 401ks, for example, that have certain kind of hard allocations to stock, bond, U.S., international, all those types of things. And so they rebalance those at the end of the quarter. And so some quarters are selling stocks and buying bonds, and some quarters it's just the opposite. And so possibly what we're seeing right here is a rebalance into stocks. And then all of a sudden the quarter ends and whoosh, the market starts to struggle if it was going up, or it turns around and comes back up, because it's sort of an artificial distortion that happens in a short period of time that's kind of driving these. And it's pretty clear. Now, I don't know that this pattern will continue on and on. Generally, patterns don't, especially as people start to discover patterns. They tend to then react to those prior to them happening, which essentially wipes that pattern out. But so far, at least in this, short time frame here that we're looking at, that pattern seems fairly clear to me. I mean, it's actually on a weekly basis right at the top or right at the bottom, except for that second quarter of every one of these moves. So we'll see what happens. I love that the market's running up right now. I think that's fantastic. I hope it just goes and we end up with, a new, trend that's definitely upward, because we're still in that kind of zone right now where if you go through the checklist of primary trend up, versus the primary trend down that we were already in, a lot of the check boxes have been checked off, but not all of them, so that could happen. Really like to see the S&P 500 get above that 4,300 peak that we had back in August. I think if we did that, we're probably off to the races. But there's so many different things that are happening with the debt ceiling and the banking crisis and, higher inflation and all these different things that are going on, and the possibility that earnings could be affected, either, the earnings reports that are coming up now or the next quarter. And there's just these pieces that are out there that are going to make it difficult for the market to run. And especially because, again, we have the Federal Reserve doesn't want the market to run. Again, yesterday, 3 interviews, and all of them were talking about raising rates and how we have to stop inflation and, all these things that would normally scare the market. And again, I think it's very interesting that the market continued up during that time frame. So here's the chart using 5-minute data for the week. And so you can see, and actually that big jump there was just an open, jump that happened after there was some talk about Alibaba in China restructuring into several different companies, some excitement about that. But really, this type of trend is what we're seeing at the end of these quarters. I mean, it's going through whatever news is out there, So got Federal Reserve people coming out saying negative things, markets going up anyway. That could be rebalancing that's happening inside of these things. So, that's just kind of what we're watching for as far as that goes. And again, I hope it just keeps going. I hope the pattern breaks and it just goes and goes. We'll get back in there on Monday or Tuesday and, we'll run with it and it'll work out great. So, having said that, we just got to be a little bit careful here because it's the end of the quarter. I mean, today's the last day, so we'll see what's happening, Monday, Tuesday. Did get a report today for the PCE. Now, this is actually the most important inflation report that comes out every month that gets ignored, actually, mainly because it comes out so late. So in the middle of the month, we got the numbers for February for the CPI. Yeah. Everybody talks about CPI. The Federal Reserve talks about PCE, which stands for Personal Consumption Expenditure Index. And this is a basket of goods designed to look at, what inflation is. The Federal Reserve likes it better because it's more balanced between goods and services, and actually has more services, but they like this, and they've been looking at this. The problem is it comes out late. Here was the last day of March. We're finally finding out what the inflation data was for February. But look at the trend. So we peaked out in July. It's been coming down, right? Now, if you look at the last month, it actually went up a little bit in February, January reported in February, but nonetheless, we're down to 5% on this particular index. Now, this is what's called top-line PCE. It means it includes everything.
Yeah, and the nice thing about PCE is also it kind of accounts for people's behaviors a little bit more. Say chicken breasts or boneless chicken breasts are going up in price, and you don't have enough money, you might go to bone-in chicken thighs that are cheaper.
Yep.
And so PCE accounts for that while CPI doesn't.
That's right. CPI just has no like-to-like type of exchanges that could happen. Yeah, exactly right. And then so core inflation, all right, so this is where they take out food and energy from the calculation. You can see it's not as smooth. Yeah, it's been moving around a lot more. Overall trend over this 1-year period is definitely down, yeah. And this is the one that the Fed looks at the most. And when the Fed is talking about getting down to 2%, they're talking about this index right here. And we're at 4.6. I keep seeing articles and hearing people on the TV and the radio talking about, wow, we got to get down from 6%, which is roughly where CPI is, down to 2%. That's so far. That's actually incorrect. PCE core is at 4.6. Got to get that to 2. But it's not going to be easy because if you look back to, late last year with that dip prior to that big jump up, we haven't really dropped that much. And so it's a little bit sticky. And we've got this situation where the banks started to struggle. So the government came out to backstop the banks. That's inflationary. Because what happens if you don't backstop the banks, everything falls apart and collapses. And so that's not good. But you don't have inflation in that environment most likely because of the kind of the economic downturn is so severe. So on the other hand, when you do backstop the banks and backstop the depositors, that means the banks can more freely lend. They created a lending scenario, a better lending scenario for the banks to borrow money from the government. So it keeps things going, but it might keep things going maybe a little bit faster, you know. And so one of the big questions that's happening right now is that the Federal Reserve is trying to slow things down. Are the banks also going to be slowing things down or not? We don't know.
Yeah, but the consumer fear could also slow things down too.
Yeah, exactly. And that's we'll see how that plays out. Definitely, we've seen some consumer confidence numbers come in today that were not as good as they have been in the past. So there's some people kind of backing off there. We did see consumer sales come out today at 0.2% for February, right? And which isn't very high. And so, the consumer might be pulling back a little bit. Could be the banking thing. That kind of definitely something we got asked about a lot. It definitely opened a lot of eyes and seems to be okay at the moment, but we'll have to see. That's still working its way through because if credit gets tightened and banks stop lending as much, that's similar to what the Federal Reserve is doing in terms of raising rates.
Yeah.
And so that's where this is so difficult. The Fed is raising rates for a future, impact to the economy, and 3 to 18 months, depending on who you talk to and what you're talking about. And so they're looking at today's data. Here it is, PCE 4.6 core, and we're going to raise rates or not raise rates. And really, what they're deciding is for something that's going to happen in the future. And if they stack too many of these rate increases on top of each other, they find out too late that it's falling apart.
Yeah.
And then if you combine that with the banking situation, if it does get worse, or maybe it already is worse to a certain degree. So these are things that are the unknowns that are happening right now that aren't normal. This is all a result of the pandemic kind of driving things. And I do have kind of a fascinating, this is a chart for the federal funds rate. This is what they charge the major banks, right? And so you can see, this goes back to 2019. We had rates were actually coming down just before the pandemic. There was some economic slowdown happening, but then you can see that cliff. Once the pandemic hit, they lowered it to effectively zero and more or less stayed down there. And then you can see the pretty steep increase that we've had.
Yeah.
It is curving, right? So it's starting to flatten out. And so the expectation from the Fed is that we'll have one more rate increase some point this year, probably the next meeting. The market's looking at a 50-50 bet for quarter point increase next meeting. And then they would be done for the rest of the year. And you can kind of see that curve happening, right? All right. So this is very fascinating. But that big drop created easy money combined with all the stimulus checks that were sent out and everything, created inflation, saved us from a depression, but is now really painful to unwind. It's created scenarios where banks are going out of business and those types of things, right? So because that easy money, people don't always do what they're supposed to do with that money. And then once that money gets tight, you get to see, who's falling apart and who's in the right spot. Now, if you look at the market, and this is the bet for January of 2024, is saying right now about 4.4%. Okay. And that's a little bit below where we are right now. And the Fed's talking about another rate increase on top of that. And so I just bring this up because this is one of the big things that the market participants are talking about all the time right now, which is just the fact that the market is expecting the Federal Reserve to lower rates, in this case, roughly about 50 basis points, about 0.5%, before the end of the year. Well, that's super interesting because the reason you would be lowering rates is because there's an economic slowdown, and probably because they overraised rates or something breaks or, something's happening. So the market's looking at that and saying, okay, with these rate increases and the steepness of that rate, curve, something's going to happen and recession's going to hit, earnings are going to drop, and, the Fed is going to actually have to lower rates. And unfortunately, when they interview, people like Chairman Powell, the head of the Federal Reserve, and they ask him, he says, no, I don't see lowering rates at all for the year, right? And so there's a disconnect there that's going to be somewhat of an issue. Throw into the middle of all this, this debt ceiling debate, which is going to start to become more and more of a topic as we head into April. Theoretically, we're already working on extraordinary measures, I guess they call it, for funding the government. And the projections are that the government's out of money in terms of what's allowed between June and the end of August, or June and September, depending on which projection. It's difficult to know what that's going to be exactly, but the political portion of this could create some uncertainty for the market too. So you've got a lot of interesting things going on right now. Altogether, it's really a fascinating time frame.
Yeah. So what were how did how did the market change for the bond signals?
Yeah, let me get back to the far shot here. So the bond signals, so we can see it better. Bond signals are turned from green on the fast trigger this week earlier to yellow. So what that means for us, green is where we're trying to buy things that might outpace the bond market or the stock market. And yellow means we're trying to buy things that are more defensive. We're still in, but maybe we're buying, in this case for bonds, shorter term things or inflation protection securities like TIPS, those types of things. And then red means we're generally, looking at T-bills or very short safe areas to try to be in and such too. So again, we have a fast and a slow trigger for those also. Yeah. And so anyway, that's what's happening this week. I appreciate everybody joining us, and I really look forward to being able to discuss this with you. We are not having a show next week, but I will probably still do the summary on Friday. And we'll put that out and put that on the channel also. So look forward to seeing you then.